Hello everyone and welcome to this presentation on the CFA Level I exam for June 2014. In this presentation, we'll look at the financial reporting and analysis section of the exam, specifically reading 25, which is understanding income statements. In this presentation, we focus on parts of the second learning outcome, which talks about revenue recognition in special cases. Now, what's the difference between this special case and a normal case of revenue recognition? A normal case is when we record revenue at the time when the goods or services are being delivered. Special cases are when we record revenue before or after the goods or the services have been delivered. In this presentation, we will look at both of these special cases, before and after the goods have been delivered, and we'll look at all of these methods for recording sales revenue for these special cases. We'll look at examples for each of these methods and see how these methods function. Now let's start by looking at the first special case, which is recording revenue before the goods have been completely delivered. Now this special case, we generally see that in the context of long-term contracts. These are contracts that span multiple accounting periods that take several years to build. For example, let's say there's a company that's in the business of constructing roads or factories or power plants or bridges. Now these projects can take several years, and the question arises, how much revenue and expenses should the company record in each accounting period? After all, the goods or the service has not been completely delivered yet. Should we record 100% of the sales revenue immediately? Should we record 0 until the good has been completely delivered? Should we record 50%? How much should we record? Now, in order to answer this question, let's look at a flowchart that might facilitate our understanding. The question we need to ask is whether we can measure the outcome of the contract reliably or not. What does this mean? Well, are we able to reliably estimate the total contract revenue? Are we able to reliably estimate the stage of completion of this contract? Are we able to estimate the total cost required to complete the contract? If the answer is yes, then under both the IFRS and the US GAAP, we use the percentage of completion method. We'll go over this method very shortly. But if the answer is no, if we cannot measure the outcome of the contract reliably, then in the IFRS, we recognize revenue to the extent that we have incurred costs. And under the US GAAP, we use a method called the completed contract method. Now, let's start by looking at all of these three methods and see how they work. Like I said, if the outcome of the project can be measured reliably, then under both the IFRS and the US GAAP, we use the same method. It's called the percentage of completion method. Now, in this method, the amount of revenue that the company reports is a function of how much work has been completed. So the company estimates what percentage of the contract has been completed, and then it reports that percentage of the total revenue on its income statement. The cost incurred for that period are expensed against this revenue, and then profit is reported each year. If the company expects to lose money, then that expected loss is reported immediately. The company should not wait until completion of the contract. Let's look at an example to see how this method works. Superior Constructions has a contract for building a warehouse for $10 million. This project is expected to take 3 years and is expected to cost $8 million. Superior Constructions estimates the percentage of work completed based on the expenditure incurred as a percentage of the total estimated expenditures. The following table summarizes total cost incurred in building the warehouse. How much income would the company record for the years 2014 to 2016 under the percentage of completion method? Now, as we see here, that the company estimates the percentage of work completed based on the expenditure incurred as a percentage of total estimated expenditure. This means that if the company has incurred 20% of the total estimated expenditure for this project, it will record 20% of total revenue for that period. Now let's see how we will record income under the percentage of completion method. Now the total revenue expected is $10 million and the total cost is $8 million. We're using the percentage of completion method, which is the same under both the IFRS and the US GAAP. Total cost incurred in 2014 is $2 million. Now, what percentage is that of total expected cost? Total expected cost is $8 million. So this is 25%, which means that we will report 25% of $10 million, which is $2.5 million. Total income reported, therefore, would be 2.5 million minus 2 million, which is $0.5 million. In the next year, for 2015, we have 4 million or 8 million, which is 50% of total costs. Revenue would be 50% of 10 million, which is $5 million, and the total income would be 5 million minus 4 million, which is $1 million. And for the last year, for 2016, we will have 25% of total cost. Revenue reported would be 25% of 10 million, which is $2.5 million. And the income would be 2.5 minus 2, which is $500,000. Now, we just looked at this method, the percentage of completion method, because we knew the outcome of the contract. And the method, like I said, is the same under IFRS and the US GAAP. Let's look at the scenario where the outcome cannot be measured reliably. So we'll look at these two methods now and see how these methods work. Now, under the IFRS, we recognize revenue to the extent of cost incurred if we expect the cost to be recovered. Costs are expensed in the period in which they are incurred, and no profit is recognized until all the costs have been recovered. So we'll recognize revenue, we'll recognize cost, but revenue would equal the cost, and therefore there will be no income reported unless and until all the costs have been recovered for this contract. Under the US GAAP, it's a different method. We use the completed contract method. This is interesting because we don't report any revenue or expense on the income statement until the contract has been substantially completed. Now, where does the billing and where does the cost go then? Because we're incurring those costs. They're accumulated on the balance sheet and they're not reported on the income statement. Similar to the percentage of completion method, if we expect losses, then under both IFRS and the US GAAP, we recognize those losses immediately and we do not wait for the contract to be completed. Now let's look at some examples to see how these two methods work. Now this is the same example that we use for percentage of completion method because this will give us a good understanding of how about the differences among the three methods. So Superior Constructions has a contract for building a warehouse for $10 million. The total cost is $8 million. The project will take 3 years. The difference here is that the outcome of the contract cannot be measured reliably. And that has to be the case because if the outcome of the contract can be measured reliably, then we will use the percentage of completion method. But we expect the cost to be recovered. And the costs, again, they're the same under the example under the percentage of completion method. How much income would the company record for these years between 2014 to 2016 under the IFRS and the US GAAP? Let's start by looking at the IFRS and see how much income, revenue, and expenses are being reported on the income statement. Now, the total cost for 2014 is $2 million incurred by the company. The amount of revenue reported would be $2 million, exactly the same as the amount of cost incurred. The amount of cost reported in the income statement will be equal to the amount of cost actually incurred, which is $2 million here. And so the income would be revenue, which is 2 million, minus the cost reported in the income statement, which is 2 million, and therefore the income would be 0. For 2015, the amount of revenue again will be the same as costs incurred, which is $4 million. The amount of cost reported would be the same as the actual amount of cost, which is also 4 million, and therefore the income will also be 0. In the third year, the year of completion, things get a bit different. The amount of revenue reported will be the total amount of unreported revenue so far. We have reported $6 million, 2 million here, and 4 million here. And total revenue is $10 million. So we'll report 10 minus 6, $4 million of revenue, $2 million of cost, and therefore our income would be $2 million. We reported $0 in income for the first 2 years, and then $2 million for the third year. Now let's look at the US GAAP method, the completed contract method. Now this is different from the IFRS because the amount of revenue reported will be 0 on the income statement. There will be no cost reported on the income statement either. This $2 million will be reported on the balance sheet as work in progress, and the amount of income would be 0 as well. For 2015, the amount of revenue reported again will be 0 because the contract has not been substantially finished yet. The cost will also be 0. Again, it will be accumulated on the balance sheet. And then the amount of income will obviously be 0 as well. For the final year, when the contract has been completed, we report $10 million, the entire revenue. We report $8 million, the total costs. And then we report 10 minus 8 equals $2 million in income. And then the balance sheet account will be eliminated. Now let's take a look at a table comparing the three methods that we have learned so far. The percentage of completion method, which is used when the outcome of the contract can be known reliably, and the other two methods that are used when the outcome of the contract cannot be known reliably. In terms of revenue recognition, the percentage of completion method reports higher amount of revenue earlier on in the life of the contract compared to the other two methods. For example, compared to the IFRS method, the percentage of completion method reports revenue exceeding the costs incurred in that period, whereas in the IFRS method, revenue is only reported to the extent of the costs incurred. Higher amounts of revenue than costs are reported only when all the costs have been recouped, and in the completed contract method, no revenue is reported at all until the contract is substantially finished. That said, in all the three methods, the total amount of revenue reported over the life of the contract is the same. In terms of income, again, the percentage of completion method reports positive income even though all the costs have not been recouped. In the IFRS method and the US GAAP method, no income is reported until all the costs have been recovered and the contract has been substantially completed. The total income reported is the same in all the three methods, just as the total amount of revenue is the same in the three methods. Also, any expected loss is reported immediately under all the three methods rather than waiting for the contract to get completed. The percentage of completion method is not considered as conservative as the other two methods. The reason is the percentage of completion method reports income even though the contract has not been completed yet, whereas in the IFRS and the US GAAP, positive income or profit is only reported when all the costs have been recovered. And finally, in terms of the revenue matching principle, the percentage of completion method is considered the best because it reports income in the period when the work is being completed. These two methods don't do a very good job of respecting the revenue matching principle because they don't report any income in the period when the work is being completed. Now, let's step back and see what are the items that we have already covered. We have looked at this special case of reporting revenue before the goods have been completely delivered. Let's look at the special case when we report revenue after the goods have been completely delivered, and let's look at these two methods. The curriculum focuses on the US GAAP. We won't talk about the IFRS treatment in this presentation for this special case. Now, the common scenario when we report revenue after the goods have been delivered is in the context of real estate transactions. If you're a company that is selling real estate assets and there is some doubt about the customer's ability to make installment payments in the future, we use either the installment method or the cost recovery method. Under the installment method, the portion of the total profit reported in each period is determined by the percentage of the total sales price for which the seller has received cash. We'll look at examples, and that will clarify matters about how this method works. In the cost recovery method, no profit is reported until the cash paid by the buyer is greater than the seller's cost of the property that has been sold. Let's look at some examples to see how these two methods work. Superior Construction sells a real estate property for $2 million. The cost of the property is $1.2 million. The customer makes a down payment of $1.1 million and will pay the remaining amount over the next 10 years. Suppose the customer pays the following amounts over the next 3 years. $100,000 in the first year, $200,000 in the second, and $300,000 in the third year. How much profit would be recognized on the down payment as well as the subsequent 3 payments under these two methods? Let's start by looking at the installment method. Now, the important information here is the sale price is $2 million, the cost is $1.2 million, and the total profit is $800,000. The profit margin on this transaction is total profit, which is $800,000, divided by the sale price, which is $2 million. Now that works out to 40%. The amount of profit reported on the down payment would be 40% of $1.1 million, which works out to $440,000. In the first year, again, it will be 40% of $100,000, which would be $40,000. In year 2, it will be 40% of $200,000, which is $80,000. And in the third year, it will be 40% of $300,000, which is $120,000. Now let's look at the cost recovery method. Now in the cost recovery method, no profit is reported until all the costs of the seller have been recouped. Total cost is $1.2 million. In the cost recovery method, we won't report any profit on the down payment. In the first year on the $100,000, again we won't report any profit because the costs have not been recouped yet. However, in the second year, we report the entire payment as profit because we have already hit the total cost in the first year. And then in the third year again, we report the entire payment as profit because all the costs have been recovered already. Now, let's look at the summary, a flowchart that tells us which method to use in which scenario for all the special cases. We start by looking at or asking ourselves whether the sale is being recorded at the time when goods are being delivered. If the answer is yes, then we don't need any special revenue recognition method. It's just a normal revenue recognition practice, and we don't need to use any methods that we looked at in this presentation. However, if the answer is no, if you're not recognizing revenue at the time when the goods have been delivered, then we will need to use a special method. We need to ask ourselves, is the sale being recorded before goods are being delivered? If the answer is no, then we use either the installment method or the cost recovery method which are both US GAAP methods. If the sale is being recorded before the goods have been delivered, then we need to ask ourselves whether the outcome of the contract is known reliably. If the answer is no, then we use different methods under the IFRS and the US GAAP. We recognize revenue to the extent of costs incurred under the IFRS, and we use the completed contract method under the US GAAP. But if we know the outcome of the contract reliably, then under both the IFRS and the US GAAP, we use the same method, which is the percentage of completion method. This flowchart can be helpful in figuring out which method to use in which scenario. Well, this brings us to the end of this presentation. I hope you found it useful. Thanks very much for watching. If you found the video useful, don't forget to subscribe and to like the video. I wish you the best of luck for the exam. Thank you.